Hey, everybody. It is end of August 2023, and the mid-year multifamily report came out from one of the most reputable brokerages in town, a commercial side, CBRE. And the way they display this report is probably my favorite way to look at multifamily statistics. I think they do a great job, and I think they make some great points. So let's dive in to some of the highlights. First things to look at are that vacancy is still low. I don't know about you, but when I drive around Salt Lake County, especially downtown Salt Lake, I see all these new apartments being built. And I own units down there. So sometimes it makes me nervous thinking, man, what if there's an oversupply? What if rents crash? What if? The reality is, when we have those apprehensions, y'all know our slogan here at Utah Cribs: we educate you so you can make an educated decision when it comes to the marketplace and your real estate. And so we do that by looking at data. Currently, mid-year 2023, the vacancy in Salt Lake is 5.3%. So vacancy, the number of units that are vacant apartments, is very low. The monthly average rent is just under $1,600. And rental growth, as far as pricing, has gone up 3.3% this year. So rents are still going up. And if you look at the year over year growth, this same time last year, it's up 1%. This data right here goes over the new permits. So how many new units are being delivered to the marketplace. And you can see since 2018, we've been delivering just between 5,000 and 6,000 units. And mid-year, we're on that same pace. We're at 3,170 units delivered so far. If you look at the Kempsey Gardner Institute report of in-migration to Utah, these permitted numbers still show that we are undersupplied. So although I get apprehension when I drive around and feel like there's a lot of units coming to market, the data says we are still undersupplied and don't have enough new buildings coming to market. Here's a breakdown of a pie chart of where those units are throughout all of Utah and Wasatch Front specifically. Most of them being in Salt Lake County. Here is a really interesting way to look at rent to income ratios. In other words, how much of the area median income for a person has to go to the average rent in that market. And as you can see, the most expensive rental market to live in right now is LA, followed by Denver, Phoenix, Portland, and San Francisco. But Salt Lake's up there, guys. Salt Lake just surpassed Seattle so far this year. Now, Seattle is more expensive rents. Don't confuse that with area median income. So 25.3% of the average person's income goes towards the average rent in Salt Lake. So it is up there, but it's still in check with other major cities. And one of the reasons for that is this chart. This shows where in the United States most of the tenants, the new renters, are coming from, where they're moving from. This is probably no surprise, but the bulk is from California, followed by Texas, and then kind of northeast Atlantic. But kind of surprising to me, we still have quite a bit in migration, 5% from Colorado, 7.4% from Florida. This is probably one of the last things I'll go over here because I don't want to make this video too long-winded for y'all. But this is a really important metric to look at. Should you buy or should you rent is always the famous question. There are times in my 20-year career where I've seen kind of average rent for an area versus what you could buy an average priced home for, and seen the rent versus the payments be quite similar. Okay, right now with high interest rates and rental growth still up, cost of rent still going up, but not increasing as drastically as it was, and real estate prices for single family homes still remaining up and interest rates being up, the ratio is rather out of whack. So right now, it costs you just over 150% more in a monthly payment on average than rent. That's drastic. To put that into real numbers, let's take Riverton right now. In Salt Lake County in Riverton, the median single family home, median price single family home is $670,000. At current interest rates, that would be just under a $5,000 a month payment. And the average apartment rent in Riverton right now is $1,856. So, it's more than double to buy. But again, take data into context. We're talking about an area's median priced single family home versus an apartment that's probably a 2-bed, 1-bath. But still, that shows you the discrepancy there. Right now, where interest rates are and out of whack, to adequately afford the median priced home in Salt Lake, the family should be bringing in $152,000 annually, and to afford the median rent income should be $82,000. Okay, so this graph shows the amount of concessions that landlords are offering, and as you can see, there was a lot of people nationally. That's the light gray line, and even more landlords locally in Salt Lake offering concessions in kind of 2019, 2020 into 2021, kind of the COVID area. A lot of people were worried during the COVID era of tenants vacating or moving out. And so they offered concessions, but vacancies did not spike. Surprisingly, even with where costs are and inflation, not a lot of concessions based on the last 5 or 6 years. Not a lot of concessions are being offered right now. It's kind of in check. What is a concession? Landlords offering, a month of free rent to move in, or, perks like that. Here's the last thing that I want to go over. And this is for you investors out there. This is for people trying to dive into multifamily. This shows the investment volume since 2009 in multifamily. In other words, how many people are buying multifamily? And this is nationally. This is not just Salt Lake. And this is investment dollars in billions. And as you can see, when rates were super low post-COVID, people dove into buying multifamily in 2021 in a big way. Over the last 14 years, 2021 was the year. And I do think that was straight interest rate propelled. COVID hit, interest rates had already been low for quite a few years, and then they went extremely low, and people saw towards the end of COVID that multifamily was still an extremely strong investment and could be leveraged at a very low interest rate. And $350 billion in 2021 went into multifamily investing. And that continued to the tune of just under $300 billion in 2022. So far in 2023, that has fallen off a cliff, and we're just over 50 billion, equivalent back to 2009 and 10 coming out of the recession. Now that we've gone over the facts, let me just add my opinion on that final chart we just looked at. If you're thinking about multifamily investment, or honestly any real estate investment now, I've told a lot of our clients pretty much this entire year, don't think that the Rich Dad, Poor Dad book principles apply right now. There is not an investment, commercial or residential, that I could pull up online right now that you could go buy that is going to cash flow if you're getting a mortgage on it. Just period. It just doesn't. Rates are too high. And so people are saying, well, that means pricing is just going to crash. And there's some reasons that a lot of experts don't believe that. One is still extremely low inventory, high demand, and a lot of sidelined cash. In my industry, the slang for that is sitting on dry powder. And there's a lot of investors I know that are sitting on cash saying, when these metrics get a little more out of whack, I'll buy. Or they're buying investments at a discounted price because pricing suffered a bit, and saying, I'll just refinance. When rates go down, it will finally cash flow. If we go back to that chart we were just looking at, and it shows the little investment that occurred in multifamily in 2009 and 10, all it really did is pent up the demand, and then we came roaring out of it 2011, 12, 13, 14, 15, and the amount of money that went into multifamily investments tripled. in the subsequent 4 years post-recession. I do believe strongly that that will occur again. Nobody knows when interest rates will go down. Everybody believes that they will at some point with how expensive everything has gotten. And in my experience, those that bought when no one else was buying in 2009 and 10 really got great buys. And as soon as they were able to refinance 3 or 4 or 5 years later, to the tune of just maybe 1% less on large commercial or multifamily deals, that 1% makes a massive cash flow difference. So I know a lot of people are saying the same message online, basically saying, well, buy now, because although the rate's expensive, you can just refinance. And as soon as rates are low, pricing is going to skyrocket. I agree with that in general, but I would reel that back in. I don't believe it's going to skyrocket. But if you want to take a real statistical analysis of investment, I do believe that the best buys are going to occur sometime between last January of 2023 and this coming February of 2024. And then we will see purchasing increase, likely at some point in the next year or so, rates level off or come down a bit. And there's so much pent-up demand, so little inventory, and so much dry powder that on the investment side of real estate, I do believe that it'll kind of pop right back up. There is your mid-year multifamily market report.